Hello everyone, I'm very happy to study international trade practice with all of you. In this course, today we will learn about negotiation of terms of price in the second section. In this section, we will mainly learn about profit and loss accounting and price terms. Today, the main content of this lesson includes: first, pricing principles; second, pricing methods; third, profit and loss accounting for import and export; fourth, price terms in contracts. First, pricing principles. The general principle for pricing export goods is to determine an appropriate price based on the international market price level combined with national policies and the intent of purchase and sale. International market prices are based on international value and are formed through market competition accepted by both trading parties. They reflect the supply and demand relationship in the international market, such as prices at commodity exchanges, major exporting countries, and large cargo distribution centers. In international trade, there are various methods of pricing. The specific method of pricing is determined by mutual agreement between the buyer and the seller. The commonly used pricing methods including the following: first, fixed pricing method; second, unfixed pricing method; third, provisional pricing method; fourth, sliding scale pricing method. Fixed pricing method refers to the situation where the buyer and seller explicitly agree on a transaction price, which is then used for settling the payment at the time of fulfillment. This is the most common pricing method in China's import and export trade, and is also a commonly used method internationally. After the contract is signed, even if the market price undergoes significant changes, neither party can unilaterally alter the originally agreed price. This means that both parties must bear the risk of international market price fluctuations during the period from contract signing to delivery and payment. Price not yet fixed method, also known as the non-fixed pricing method, is colloquially referred to as flexible price in business. For certain goods whose international market prices fluctuate frequently and significantly, or when the delivery date is far off, and the price trend is difficult to predict. To avoid risks, the buyer and the seller do not explicitly agree on a transaction price in the contract. Instead, they only stipulate the time and method for pricing. To avoid price risks, when negotiating forward transactions for goods with highly fluctuating market prices, the buyer and the seller may first stipulate a provisional price in the contract, which serves as the basis for opening a letter of credit and initial payment. After the final price is determined by both parties, the settlement is made with any overpayment refunded and any underpayment supplemented. This method is called the provisional price method. However, the drawback is that there is a possibility that the parties may fail to reach an agreement on the final price due to differing opinions, leading to the inability to fulfill the contract, which introduces significant instability. The final sliding price method refers to the practice of initially stipulating a basic price in the contract and then, at the time of delivery or a certain period before delivery, adjusting this base price in accordance with indices reflecting changes in wages and raw material prices to determine the final price. Let's look at a classroom discussion question. What are the advantages and disadvantages of the fixed price method and the non-fixed price method and the provisional price method? Let's think about it. The advantages of the fixed price method are that the price is clear and specific, making it easy for accounting and bookkeeping. The disadvantages are that both parties carry risks, and when the price trend is particularly unfavorable for one party, it can easily lead to intentional breach of contract. The advantages of the non-fixed price method are that it avoids the risk of price changes by not fixing the price, while the disadvantages is that it can easily cause instability in contract execution. The advantages of the provisional price method are that it facilitates the issuance of letters of credit and the preparation for payment. The disadvantage is that both parties may fail to reach an agreement on the final price due to their differing opinions, which can lead to the inability to fulfill the contract. The third point, the profit and loss accounting for import and export is mainly divided into export profit and loss accounting and import profit and loss accounting. Foreign trade enterprises, while fulfilling their export tasks, should strengthen the cost accounting of export goods, which is an important indicator to measure the operational management level of foreign trade enterprises. The cost accounting of exports involves 3 data points: the total export cost, the net foreign exchange earnings from exports, and the net RMB earnings from exports. Based on the 3 data points, one can calculate the export profit and loss rate and the export exchange cost. The total export cost refers to the total domestic cost paid by foreign trade enterprises for exporting goods, which includes the purchase cost and domestic expenses. For goods that require the payment of export tax, the total export cost should also include the export tax. The calculation formula is as follows. The total export cost equals purchase price of export goods plus domestic expenses minus export tax rebate income. The net foreign exchange earnings from exports refer to the total foreign exchange income from exports after deducting non-trade foreign exchange expenses such as freight, insurance, and commissions, which is the foreign exchange income obtained from transactions at FOB prices. The net RMB earnings from exports refer to the total amount of RMB obtained by converting the net foreign exchange earnings from exports as the prevailing foreign exchange rate. Export profit-loss ratio refers to the ratio of export profit-loss amount to the total export cost. Export profit-loss amount refers to the difference between the net income in renminbi from export sales and the total export cost. If the former is greater than the latter, it is profitable, otherwise it is a loss. Export profit-loss ratio equals net income in renminbi from export sales minus total export cost divided by total export cost. The export exchange cost refers to the renminbi cost required to earn 1 unit of foreign exchange from the net income of an export commodity. In China, it generally refers to the RMB cost incurred for each net income of $1 from an export commodity. That is, how many RMB are needed to exchange for $1. If the export exchange cost is higher than foreign exchange rate quoted by the bank, then the export is at a loss. Conversely, it indicates a profit from the export. The export exchange cost is equal to the total export cost divided by the net foreign exchange earnings from export sales. The export exchange rate of return is also known as the foreign exchange appreciation rate, which refers to the ratio of net foreign exchange earnings from the export of processed finished products to the foreign exchange cost of raw materials. The export exchange rate of return equals net foreign exchange earnings from export minus total foreign exchange cost of raw materials divided by the foreign exchange cost of raw materials. The principles of profit and loss accounting for import business are the same as those for export profit and loss accounting. It mainly involves calculating the total import cost and the import profit and loss amount to account for the import profit and loss rate. The import profit and loss rate refers to the ratio of the import profit and loss amount to the total import cost. The import profit and loss amount refers to the difference between the net RMB income from domestic distribution and the total import cost. We come to understand the price terms in a contract. A complete set of price terms in a contract should include the unit price, the amount, and the total value. If a contract involves more than one type of commodity, the amount for each commodity needs to be calculated separately. That is, the unit price multiplied by the quantity, and the sum of the amounts for all commodities is the total value of the contract. The total value of the contract must be expressed in both numerical and written forms. We focus on the key issues to consider when establishing price terms. First, the numerical and written amounts in the contract must match with the English written amount, being complete and standardized. Second, strive to choose a favorable currency for pricing to avoid the risks brought by currency value fluctuations. That is, for exports, strive to settle in a hard currency, and for imports, strive to settle in a soft currency. If an unfavorable currency is used for pricing, an exchange rate protection clause should be added. Third, if the delivery quantity has agreed upon a margin of flexibility, the amount and the quantity should be stipulated to increase or decrease simultaneously. Fourth, use various pricing methods flexibly to avoid the risks of pricing fluctuation. Fifth, refer to the customary practices in international trade and pay attention to the reasonable use of commissions and discounts. Alright, our class today comes to an end. Please go back and review the content of this lesson and preview the next chapter. See you in our next class.